let's see. I'm just doing one last test, make sure we're good. Yeah, we are live. So hello, Facebook, hello, Zoom, wherever you are joining us. It is Thursday, May 14th, and we are live with about 70 degrees of weather. It's a beautiful day today. So thank you guys for joining us, especially on such a pretty day. And hello, Ryan. Thanks for coming again.
Yeah, thanks for having me.
Ryan was with us, I want to say, was it last week or the week before? But
2 weeks ago. Time is not a thing.
I know,
anymore
right?
for me, but...
By the way, as far as time goes, we are on our 9th week of quarantine, which is pretty crazy, which explains my weight gain.
COVID 19 pounds.
Yes. But the last time we had Ryan on, I got some really good feedback. I recorded the video, put it on YouTube, emailed it out to some of my clients, and everyone gave great feedback. So we are happy to have you back again. For those who don't know me, I'm Danae Aballi. I also have my business partner, Lenore with us.
Hi.
And Ryan Grant works for Fairway Mortgage. He is an exceptional lender, and we know a lot of lenders, and Ryan is one of the best for sure. So he's very knowledgeable, but he's also very caring, and he is an excellent guy in terms of taking care of his clients and really helping them analyze the right move for them. And that's why I wanted to have him on today. So Lenore, you want to give him a little intro, tell us a little bit more?
Sure. So today Ryan's going to talk about 4 things that is burning in everyone's mind. The first one is the direction of the housing prices. What's going to happen? What's the prediction? The second one is the direction of mortgage rates. Are they going to go up? Are they going to stay down? What in the world's going on in the mortgage world? The third is the future of rental prices. A lot of people think they're going to crash. Love to hear what Ryan's take is on it. And the fourth is a sample of a rent versus own scenario to see if it makes sense for you to rent or purchase now. So yeah, all this stuff is great information. I'm looking forward to hearing it too.
Absolutely. And I will tell you too, just a couple housekeeping things. So if you're watching us on Zoom, there is a Q&A button at the bottom of your screen. If you have any questions, definitely feel free to interrupt us and ask anything you want. We will give you the straight up answers. And if you're watching on Facebook Live, same thing, you can comment or message us below and we will do the same, answer all of your questions. So Ryan, anytime you're ready, you can take the stage.
Awesome. Well, thank you guys again for having me. So I prepared a little presentation, so I'll just share my screen. Because I'm doing that, I won't be able to look at any of the chat or any of that stuff. So just interrupt me or blurt out, or Lenore, just let me know if you see anything, and we'll answer any questions along the way.
Awesome. Thank you, Ryan.
Yeah, of course. All right. So let's jump into this. So really just wanted to talk about, is this the right time for you to buy a home, and why is that the case? And before I even start, anybody who's watching this or will ever watch this, I think the most important thing for you to know about Danae and her team and myself and my team is that we honestly don't care if you ever buy a house. I think that probably sounds strange, but what we care about is that you have the right information, the right education, and that with that you can confidently make a really good decision. Right? And if after you have all this information, then you decide it makes sense or it's right for you and your family to buy a home, awesome. We'll help you take those steps. And if for some reason it's not the right time, then we'll just help you with a plan and a strategy and a timeline to help accomplish that here at some point in the future. So really this is meant for everybody to get the information and education they need. This is going to be very high level when it comes to we're just picking an area and an average person, right? And we know that you're not looking at an area and an average person. You're very unique in your situation. So when we get to the end of this, the best thing you could do for yourself or for anybody that you know that just wants more education, just reach out. We can have a consultation specifically with them around their unique situation, their financial situation, their goals, kind of where they need to be. So just kind of wanted to lead with that. But moving into kind of our first slide here, I wanted to get everyone just a snapshot of what the real estate report card in Orange County currently looks like. And again, you could be in any county, any city. This is kind of where it stands as of today. So I pulled this information earlier this morning. Median home price right now is about $808,000, which is about $438 price per square foot. We've historically seen about a 6.3% price appreciation over the last 60 years. We've seen 4% growth out of the last 10, 4.11 over the last 5. We expect about 3.6% growth this year and about 33% over the next 5 years. You can kind of see the growth over the next 5 years in terms of what that means. You can see how many people we have in Orange County, 3.2 million, of which there's 1.44 million people renting. We'll talk about why that's an important number later. And there's about 260,000 people who are renting who can actually afford to buy a home. They may just not know how, or if they can, or if it's the right time. One of the telling things here is that, number of new household formations is about 43,000. And then first-time home purchases to be taken from inventory, there's only about 10,000 homes being built right now. So you can see the actual number being built versus the number of homes needed to be built to keep up with the level of demand or the new household formations. So that's why you're going to see both rents and home values rise simultaneously. But I'll dive into that in a little bit here. So the first thing that everyone's asking, at least right now, so this presentation is different today than it would have been 8 weeks ago. But everyone's going to ask right now, well, is now the right time, right? Especially with COVID and everything going on and 35 million people who are unemployed. The answer I have is always going to be specific, but in this case, it'll be general. The first thing we want to take into consideration is the fact that we don't want to fight the Fed. You guys may have heard that term before, don't bet against the Fed. So the Fed, you can kind of see here, coming out of the 2008 recession, they kept interest rates at 0 all the way through to kind of the beginning of 2016. Interest rates started ramping up, and then they bottomed them out again here, and they'll probably bottom them out for the next, I would say, 3 to 4 years at minimum to make sure we kind of come out of this recession as well. Even though this recession wasn't caused by anything economically, it was caused by something biologically. So the fact that they're going to keep rates low and keep purchasing treasury debts and mortgage-backed securities just means that they really want to make the recovery as robust as possible, and mortgage interest rates will stay low and actually move lower. So we'll talk about that a little bit later. In terms of foreclosures, we get that question a lot: isn't there going to be a lot of homes that are going to go into foreclosure? Doesn't that mean home values are going to drop? And the answer is really just probably no, right? Again, not 100% certainty, but there won't be, again, a lot is a subjective word, but there shouldn't be so many foreclosures that it would have an impact on housing prices. And mainly because, 58% of all homes in America have at least 60% equity, and 42% of all homes are owned free and clear, right? So these are just astonishing numbers that back in 2008 were not even remotely close. Most people back in 2008 were buying homes with 0 money down. They were buying them and flipping them quickly. So the majority of what people lost was the difference between 0 down and a 0 equity position. You can see here this graph. And by the way, I'm happy to send this out to anybody who is interested. You can just email Danae when this is done, and we'll share with you this entire slide deck so you guys can have it as well. But you can see here, again, 42% have 100% equity, 60 to 99%, or I'm sorry, when you add these two together, you have 16% have 60 to 99%. So there's way more equity in today's modern housing market than there was back in 2008, which just means that if you're having trouble making your mortgage payment, you wouldn't go into foreclosure. You would just do a normal sale, right? You would just sell your home like normal. So, and you probably wouldn't even discount the price all that much because of supply and demand. Going into this, we saw a phenomenal amount of demand for housing before the COVID hit, and a very limited amount of inventory. There just weren't a lot of homes for people to buy. And what we see, go ahead.
Sorry to interrupt you, but it just brought up a point that I wanted to bring up. So I've heard this a few times before from buyers who thought maybe if people start selling their homes, they'll get this big discount. And one thing I just want to be clear on is that let's suppose you owe the bank $400,000 on your mortgage, and your house is worth $600,000. If you do stop making mortgage payments and the bank sends you a letter saying we're going to foreclose on you because you aren't making your mortgage payments, as that home seller, you actually have the opportunity to sell it, and whatever cash you get over the $400,000 that you owe them, if you get a $200,000 extra, you get to keep that money. So if you do fall behind in payments, make sure you call us realtors. If you don't call us, call another of your favorite realtors, but that equity is yours. So you don't want to just let the house go to the bank. You want to actually sell it and take the spread of your equity difference. So I think most people know that, but I have had it pop up in a few conversations. So I just want to throw that out there.
Yeah, it's good information to point out. And then the second part of that is forbearance, right? So that kind of is a good lead into this, is that right now, if people are having trouble making their mortgage payment, they just quite simply don't have to, right? So banks are issuing forbearances, allowing people to have, up to 6 to 12 months of payment relief to where they're not even considered late, right? So it helps people get through this challenging time. Side note on that, if you are going to go into forbearance, know that there could be some challenges getting out of it, or it may not be as easy as you think coming out. A lot of people think they just defer it to the end of the mortgage, and that's almost always not the case. So if you are watching this and you are a homeowner and you're thinking about going to forbearance, please reach out to whomever you trust the most to give you good guidance and advice about if you should go into forbearance, if it makes sense for you, and how it will impact your goals down the line, especially because interest rates are going to get real low here soon. So we want to make sure that people are able to take advantage of those. But another reason why there's just not going to be a lot of foreclosures, because most people won't even have to make their housing payments. The question is going to be when forbearances stop, or when they stop allowing them, or people get done with their forbearance timeframe, what's going to, are they going to be able to afford the home at that time? And if the answer is no, they'll know it going into it, and then they'll put the home on the market well before it would ever go to foreclosure because they have the equity position. So again, there may be some, but it's going to be few and far between. And even a bank, let's say it does go into foreclosure. Let's say they don't have enough equity. Maybe they put 3% down. Maybe the market retracts a little bit. So maybe it does go into foreclosure. Well, the bank does a price opinion of that house. They're not going to sell it for a discount. They're going to sell it for a fair market value. And if there's more demand for housing than there is supply at that time, and the bank is going to sell it for a normal price and probably get multiple offers on it, because people look for foreclosures thinking they're going to get a deal. And so oftentimes foreclosures are bid up. So it's just, it's going to be a challenge to find a quote unquote deal or find foreclosures that are going to bring housing values down, unless something real terrible happens. So another question we get a lot, is this going to be like 2008? Again, 2008 was very different. This was price appreciation leading up to 2008, right? So 8%, 6, 8, 8, 12, 11. I mean, home values should not have gone up that much. They were artificially inflated because we would give a mortgage to anybody that could fog a mirror at that time. Whereas now you can see normal price appreciation over the last 6 years leading up to where we are today. And then again, mortgage credit or mortgage availability index, the higher this number is, the easier it is to get a loan. You can see here, any human being that was roughly 18 years or older could get a mortgage because it was stated income financing. And ever since then, it's been challenging to get a mortgage. And this graph is actually moving down. It's trending back down because it's becoming more difficult to get a mortgage as banks start to tighten up their lending standards because of COVID and where it stands today. So we're just not going to see the same fall from grace that we did back in 2008, because we weren't lending money to people who couldn't afford their home back then, or at least now. Another thing is, people think, well, if we're in a recession or even a depression, we're going to see home values come down. And this is the last 5 technical economic recessions that we've had. You can see in 1980, home values actually went up. 1981, same thing. 1991, we had a nominal pullback for a short period of time. 2001, or the dot-com crash, we actually saw home prices go up 6.6%. So this was really the only one back in 2008, and that's just because the housing caused this recession. This was caused by the dot-com. These were caused by savings and loans. So really, this was an anomaly, and housing prices never should have been to the point where they were, which was really what caused them to retract. So the estimation is we won't see anything even remotely close to that, and I'll show you why here in a second. This basically talks about home prices, relative to the kind of the sharp correction in sales. Says the market was well positioned heading into this recession, where inventory of existing homes was lean and builders were cautious about adding supply. Again, just supply and demand. Lending standards have been tight with high credit scores and reasonable down payments, so it would reduce the risk of foreclosures. And then government policies, most notably forbearance programs, should keep people in their homes and avoid sales. And this is, you can see the source here, right? The source is about 50 different people, all coming up with kind of the same data. So the expectation is that, again, we'll see a pretty stable housing market. Just in the last 4 weeks, every week for the last 4 weeks, we've seen an increase in purchase mortgage applications. And in the last week, it was an 11% jump in purchase mortgage applications. So we're already seeing that demand come back at a pretty high level, even before states or businesses are really even reopened. So if that gives you any indication on how heavy demand is right now, I think it's a big indication of what's to come. So this was the housing forecast pre and post COVID. So B of A Global Research anticipated about 4 to 5% growth in the housing market, basically for the next 5 years straight, right? Pretty flat line. Post-COVID, they saw, okay, well, that's not going to happen, right? So they saw demand that was going to move down. Now, what they're actually estimating is about a 2 to 3% correction. Now, this is nationwide, mind you. So you can't look at every market the same. You'll look at headline after headline in the news saying 35 million people unemployed. And the unfortunate circumstance there is that the majority of that 35 million was kind of lower income sectors. They were, servers, bartenders, hospitality. And so really the lower end of the housing market is going to be more affected by that because those people are the ones that are having challenges from a demand perspective buying a home. So I don't think in Orange County we're going to see this simply because we're still seeing multiple offers and we're still seeing incredible demand right now. But even if we do, you can see it's a sharp, a real quick little 2 to 3% move. And then within 6 months, we're about to see a 7% jump. And again, it's all supply and demand. There's just way more people that want to buy a home than homes that are available to buy. So for anyone who thinks, well, maybe I'll just wait and try and buy in the, beginning to middle of 2021, you have to understand that's probably what a lot of people are thinking. Right? And so when that happens, it's going to be multiple offer situations. You're going to see it turn from a somewhat balanced market, which is kind of where we are today, where sellers and buyers are meeting and they're negotiating well, to multiple offers, sellers not negotiating at all, and buyers having to bid each other up, which not only means that you may have to bid up above that 2% where you already thought you saved the money, but you may not even get the home at all. I mean, we have very few clients who we've helped over the last 15 years have called me and said, you know what, I really wish we would have saved 2% on the purchase price of this home because they're all just extremely excited to own that home. And the appreciation they've gotten over the last 10 years has been really life-changing for them. So, looking at it as a national average, we may see that 2 to 3% pullback. I think here locally, we will probably avoid that. But one thing that makes it an opportune time now is we are seeing some sellers who are willing to negotiate. So maybe when you write an offer as a buyer, you could ask for 2 to 3% seller concessions. You can use that to pay your closing costs. You could use it to buy down your interest rate to an incredibly low interest rate. And you can essentially negotiate this small dip out of the equation, which means you're starting at square one, having nowhere to go but up for the time being. And this is not a decline in housing prices. This is just a decline in percentage of growth. So you can still see even in 2025 and beyond, we're still growing at 3 to 4%. So home prices should still increase there. This is going to show you interest rate trends. Now, this Fannie Mae should be coming out with their May forecast here pretty soon, but the important part of this to look at is just going to be 30-year fixed mortgage rate estimations. So you can see, we were at 4.4%. We were even higher than this at the end of 2018. We were at about 4.8%. Beginning of 2019, 4.4, and you can see we've gradually been coming down. These were all higher back in March when Fannie Mae was estimating interest rates moving forward. But you can see we're going to get into the low 3s and even the high 2% range into 2021. So you can imagine with interest rates that start with 2s for 30-year fix, which has never happened, you can imagine the amount of people who are going to want to take advantage of that, right? And the amount of the ability for people to borrow money at a cheap rate is going to create so much demand from a buyer's perspective with a continual lack of inventory because builders aren't building fast enough. And there's not a lot of people who just frankly want to sell their homes, right? And so a lot of people are keeping as investment properties. And so we're kind of turning into this renter nation because the millennial generation has so many people, and we're in our, when I say we, I'm kind of the top end of it. I'm 37, the top end of it's 39. We're either in our entry level first time home buyer phase, which is going to be maybe the early 30s, or our move up level, which is going to be our mid to late 30s. But that's a massive amount of people who are either buying first time or moving up to their longer term home. And with rates that low, the demand is just going to significantly outpace the supply. And it really just comes down to, I hate to say it this way, but it's like kind of like the haves and the have-nots, right? And the people who are able to get into a home will definitely be the beneficiaries of it over time. So the question is, can you or should you? And that's what we want to help you guys better understand here today. So getting into kind of rental prices, again, I just took a snapshot of Irvine. It's where we're located. It's the most central location in Orange County. It's not the highest price by any means. It's not the lowest price by any means. But you know, it's kind of going to be in that median sweet spot. So let's just look at an average Irvine, California rental, and you can click on this link here and see all the data. I just took a screenshot of it, but the average rent is $2,468, and the average rent increase is 4% year over year. Right. So if we look at that number, let me pull up the calendar here, and we have $2,468, and we times that by 1.04. It means we're going to go up by about $100 a month. Well, I'm sorry, $100 a year. All right. So that is going to be important as we go through our analysis. And that is for a 1-bedroom apartment. That's closer to this average. Well, it says 2-bedroom apartments are more generous square footage. So we'll keep these numbers in mind. You know, about $100 a year in expected rental price increases. And for a 2-bedroom, and this is apartments.com, I did some research on, you can see all the places for rent right now. So the average 2-bedroom apartment in Irvine, California is renting for about $27.78. So we'll use that number when we start our analysis, but good number to know. And then 1% of that number, we'll just call it $100 to round it off per year. Now, people say, well, rents aren't going to keep rising. There's no way they can keep rising. And unfortunately, that's not really the case. So I included this link to this article here. I won't bore you all with the entire article, but these are all the reasons why rents keep going up, right? One is that there's just low housing inventory. So when there's not a lot of homes to buy, that means everybody has to live somewhere. So there's going to be a huge demand for rental properties. So that will keep demand moving up, and the landlords or the property owners can control that. If you just look online, just Google why are rents rising during COVID right now, and it's because landlords know that people can't afford, like people aren't going to be able to buy homes right now because their income is challenged, and it's not the most morally correct thing to do, but landlords are raising rents as much as they can, and a lot of cities are having to put rent increase stoppages in place. In Orange County, Santa Ana was the only city who put a rent control in place citywide, not allowing landlords to increase. Every other city in Orange County is allowing landlords to increase rentals right now, which many are doing. Median home values went up even slightly, but they're still moving up. So when home values go up, rentals go up along with it. Down payments aren't getting any cheaper. So mortgage rates are dropping, allowing mortgage payments to become cheaper, but down payments are still a down payment. You still have to put 3%, 5%, 10%, or 20% down. So as home prices go up, people have to save more money to get into a home. And that's typically the biggest inhibitor of what we see. We're fortunate to be the number one lending team in Orange County. And our biggest challenge is helping our first-time home buyers with the down payment, right? Like, where's that money going to come from? Because, our generation, or the millennial generation, is pretty good at making money. It's hard to keep it, right? Orange County is an expensive place to live. So they have to, a lot of them are using gift funds from parents. They're using, they're kind of co-investing in real estate with their parents. But the question as to why aren't people buying home is just because it's costing more and more money to put a down payment on a property. Occupancy rates remain high. There's just not a lot of open rentals for rent right now. I looked, we have a rental property in Irvine, and I was looking the other day just to do kind of a rent survey, and there was like 4 homes even for rent that I could even compare it to. So it's just there's not a lot of vacancies in the rental market. Number 5 is just going to be growing demand from millennials and baby boomers. We already talked about that. Baby boomers are looking to downsize. They're going to be challenged from a retirement perspective. The average 65-year-old has $59,000 saved in retirement funds, which means that a lot of them will most likely sell their properties and move to a rental situation at a lower price point, or buy something less expensive. But there's 83% of people's wealth is in their home statistically. So if that's your retirement, you have to sell it, live off that retirement, and then rent something. So when you have baby boomers moving into that rental space, along with millennials who can't buy moving into that space, there's just not a lot of places for rents to go except to continue to rise. Renting offers more flexibility. We see it as a big trend from millennials, is just having flexibility, not being tied down. So people like that feeling. And then they get to avoid property maintenance and repairs, which are costly. There's truly a study that was done that says 44% of Americans have some form of regret within 1 to 2 years after they buy a home. And the number one regret is that they didn't know how much it would cost to keep that property up or repair, and they wish they saved more money and didn't put as much money down. And that's just a product of not getting good advice from a mortgage professional, because that's one of the biggest things we talk about is liquidity, emergency fund savings, cost of being a homeowner. So when we're helping you figure out, should you buy a house or is it a good time? That's a big part of it. It's not just can you, because a lot of people can, but should you? That's a different story that a lot of people don't talk about. And then in this article, you'll see 3 reasons why rents may continue to rise and 3 reasons why they may slow down. A lot of it's the same, so I won't bore you with it. So next, I want to kind of move into our analysis here, and we'll use a lot of the stuff that we learned in this to help you with it. Let me move this out of the way. Okay. So here is an analysis that will help you understand this. Okay. So this is just a sample buyer.
Hey, Ryan.
Yeah, go ahead.
Sorry to interrupt again, but I've seen you use this, I guess, spreadsheet or website for actual clients and their actual situation. So you're showing a sample home buyer, but if you want an actual scenario, you can do that for them, right?
Yeah, so that's kind of what I said in the beginning. This is all just a bunch of, this person looks like this, right?
Average,
but no one looks like this. Everyone's got outliers and individual uniqueness. So the key when you're looking at this is not to take this as anything really important. It's to know that if you're not getting this type of education or analysis, or if you're sitting at home wondering, I wonder if I should buy a house, like, this is what you need. You need to go through this process, because the thing that I dislike about the mortgage industry the most is the way that most people are treated in it, right? So Danae, if you were an average client and I was an average lender, you'd say, hey, I was referred by Lenore. She is a realtor and said that I should buy a house and I should call you to get pre-approved. And I would say, awesome, Danae, fill out this application online, send me these documents. You would do that. I would then say, all right, you're pre-approved for X. Here you go. Good luck. Let me know when you find a house. And so when I tell people, I go, did that happen to you? They go, yeah, that was exactly how my pre-approval worked. And I say, look, I'm really sorry that happened, because all you know is what you can do, but you have no idea what you should do, right? And then the two things are very different. So it's key that you go through this type of experience to have the confidence and the motivation that you need to make a choice to buy or make a choice not to buy. But again, that's all we care about, and this will help you do that. So let's go back and let's use that. It was 27. What was that number? It was 2778. So I'm just going to lowball it, and I'll use 2700 for round numbers. So let's say you're, and Danae, I'll have you walk through this with me. So you're renting right now. You're renting a 2-bedroom apartment. You're paying about $2,700 a month, and you're trying to figure out if you should buy a house or not. The mistake that most people make is they compare that $2,700 that they're paying today versus the new mortgage payment. And that's like comparing apples and oranges. It's comparing where you don't want to live versus where you do want to live. So I would say same thing to you as I say to all of our clients is, Danae, could you, like, let's assume we get to the end of this and you decide it's not a good time. Could you happily and comfortably live in your current rental right now for the next 5+ years? Most people would say, nah, not really. That's kind of why I'm looking to move in the first place, right? So if I don't buy something, I would probably rent something bigger, right? Because I want to, maybe having a family, or I'm moving up, or I want a yard, or whatever the case may be. So let's say that's the case. And I would say, okay, so if you move up, how much would you pay to maybe get that 3rd bedroom, right? Usually what we hear is about $500, and we could run the analytics for them. So if we were actually running an analysis, we'd actually go online and we'd do some research, and we'd say, okay, you could find a 3-bedroom for $3,200. So let's just start there. Now at that $3,200 number, we looked up the year-over-year rental increases, right? We know it's about 4%. So conservatively, that's $100 a year. So in 5 years, which is, we always want to look out at least 5 years, that's going to be $3,700 that you're paying here. So if we did an average of that, it would actually end up being $3,450. Do you understand how I got to that number?
Yeah, that makes sense. I think one thing we all underestimate too is like a 1-year lease just goes by in a blink of an eye. So 1-year leases always turn into 2 or 3 or 4, and that's, you know, not even counting, like you said, you know, bigger place and switching around. So it always goes quick.
Yeah, we've had one of our renters, you know, who initially just wanted to do a 1 year, and they've been there for 4 years now.
Yeah.
And so, you know, we want anyone who's making a fair comparison between renting and owning. You want to compare where you will live for the next 5 years versus where you will rent for the next 5 years versus where you will buy for the next 5 years. And you want to take into consideration rental increase values, right? So once we get a good estimation of what that is, then we can really give you better advice. Because if you're just comparing, well, I pay $2,700, it was like, well, you don't want to live there, so why would you compare that? Because you know you're going to move. So we help people square in on this number because we don't want them to make a decision and then be like, oh man, I really wish I would have bought, but we have to help them understand why that might be the case. So then we'll get into kind of our borrowing analysis here, and we will look at, let's just say, you know, I know you could buy a $700,000 house, and you're going to be the expert here. For $700,000, could we find a 3-bedroom condo?
Yes.
Okay. So I'm just going to update these. And, you know, for sake of time, I'm not going to walk everyone through the 20% down and the 10% down. I'm just going to go right to 5% down because over 90% of our clients, when they buy a home, or first-time home buyer clients, I should say, put less than 20% down. So the myth of you have to put 20% down is not only not correct, sometimes it's just flat out not appropriate, especially with how cheap money is today. So we'll walk you through kind of what that looks like, but let's just go right down to Ryan. I don't have a lot of money to put down. You know, I saved a little bit, and maybe my parents can help with a little bit of gift, or I can access some from a retirement account, because as a first-time home buyer, you can withdraw from a retirement account or an IRA of some sort. You don't have to pay the penalties. You can borrow against it. You could pay that back. So there's a lot of ways you can use tax refund. There's a lot of ways in which you can help fund a down payment. We just would walk you through what those options are and try and help you analyze where the money could come from.
You know what, Ryan? It just popped in my head too. You're analyzing 5% down up to a $700,000 purchase price. And I think one of the challenges I've run into is sometimes people think, well, you can only put 5% down if it's a, like, say, $300,000 condo. And that's not true. You can get like a really nice house, a $700,000 house, for the same 5% down. There is a limit, I know that, but it's a lot higher than I think people realize.
Yeah, so Orange County has a, you know, we're at what's considered a high balance. Orange County, Los Angeles County, we can go up to $765,000 for a loan amount and still be considered a conforming loan. So you could buy an $800,000 property with 5% down, right? So you could buy 800,000, 40% down, 40,000 down would give you a $760,000 mortgage. So yeah, a lot of people don't know that is a thing, but definitely is. So the challenge that a lot of people face is, let's say, okay, so they're going to go on Zillow, they're going to look around, right? And people want to avoid real estate agents and mortgage lenders before they're ready, and for good reason. Most real estate agents are salespeople. Most mortgage people are salespeople, and if you call them, they'll never stop calling you. But you know, Danae's team and my team, we are very much the opposite. We are consultants and advisors. And our goal is to help you just answer your questions and help you make better decisions. So before you go online and scare yourself or get too overly excited, you know, it's good to start talking with us because we can help give you some perspective and help you set expectations appropriately. And so one of the ways we do that is by just going through some numbers with you. So as opposed to you going online and be like, "Ooh, I found a $700,000 3-bedroom that looks great for me," and then you go to a mortgage calculator somewhere you find online, and you figure out it's going to cost you $4,200, and you immediately just go, "Oh God, I can't do that," right? And your home search is over, right? You're no longer in the market. It took you 20 minutes, and you've shut the door on becoming a homeowner. That is 90% of the time what happens, right? People just do it themselves. It's kind of like WebMD, where you try and self-diagnose yourself. Never a good idea. So come to us first and we can help you understand that. So here we would walk you through this challenge, right? First of all, you wouldn't be comparing $2,700. You'd be comparing $3,490 because we would have walked you through that process. And then you can start to see some greater numbers. Now, one of the cool parts about buying a home is that there oftentimes are tax benefits. Now, not always. It depends upon your standard deductions, your marriage, if you're married or not, your income levels, your tax brackets. But I just estimated kind of the most conservative tax benefit for this analysis. And by buying this home, you save about $234 a month, assuming you make roughly about $150,000 a year individually or combined. And so, and this payment, by the way, it would be inclusive of your property taxes, it'd be inclusive of your insurance, it would be inclusive of mortgage insurance for putting less than 20% down, and your HOA, right? So everything all included in that monthly payment. Nothing else would be a surprise or out of pocket. So we're gonna come down here and we're gonna look at the difference, right? So we have, this blue column is the rental column. So we added $40 for renter's insurance. So you'd be paying $35 or $34.90 per month to rent this home on average over 5 years. Now, if you were to put 5% down, you'd have a payment of $41.97, but you'd have a little bit of a tax benefit, which an after-tax net payment becomes about $39.63. Still probably more than you wanted to pay, but it's a lot closer, right? It's only about $473 difference than what you would pay on average over the next 5 years to rent that property. But what a lot of people don't understand is, maybe they do, but they just don't take into consideration, is that when you make a rental payment, nothing comes back to you. It's all going to the landlord. When you make a mortgage payment from day one, you're putting $1,000 or $1,100 into your own kind of forced savings account. You're creating your own equity. That's you paying down the principal, which is still your money, right? So when you look at that, it's actually over a $600 benefit by buying this home, because you can't think of that as a payment to someone else. It's a payment to yourself, right? So now if we want to look long-term, and this is one of my favorite questions to ask, it's kind of funny, is, Danae, how much are you paying in rent? And you'll say $2,700. I'd say, okay, how much are you going to pay over the next 5 years? No one ever knows that number. You know why no one ever knows that number? Because it's a terrible exercise to go through. Nobody wants to calculate how much money they're going to give away over 5 years, because nobody actually wants to do that, right? So we show them, right? Because it's our job to help people see the future. So I would say, Danae, are you aware that over the next 5 years, you'd pay your landlord on average $225,000, and you'd have zero equity and zero tax savings to show for it?
That's insanely painful. That's $250,000. No, thank you.
Yeah, I promise you, no one wants to be this person, right? I mean, people will get emotional in our office when they start to see this, and they this kind of visceral reaction to, oh my God, I didn't realize that, right? Like, I didn't realize that if I rented the 3-bedroom that would support my family, that I would give up $250,000 and have nothing to show for it, right? Because we don't teach real estate or finance anywhere in our society, so I don't know why people would have an understanding of that. But then what we can show them is, look, if we do 5% down, right? Now, going back to this report card here, we'll be able to see over 60 years, we've averaged 6.3% growth in Orange County, right? Over the last 10 and 5 years, it's been 4%. We're expected to be 3.6% next year, and over 5 years, about 33.65%. Again, supply and demand is going to push that number. So let's just use an average of 4%, right? That'll be our expected home price appreciation for the next 5 years. So if they buy that home for $700,000, over 5 years, it would grow to be worth $854,000. They would have paid their mortgage down just organically by making normal monthly payments to $593,000. They'd have $260,000 in equity versus zero, all while paying only about $473 per month more on average. So the difference is, if you're going online and trying to figure this stuff out on your own, you're going to scare yourself, and you're going to think there's no way I should do that. Whereas when you sit down with a mortgage professional who really cares about giving you accurate advice, and a real estate professional who cares about helping you make a smart decision, not an emotional one, you'll start to realize that it's sometimes actually financially irresponsible not to buy the house that you were afraid to buy an hour before you started having that conversation. Right now, the key word there was sometimes. Right, there's plenty of situations where people are getting a screaming deal on their rental, right, and their parents are renting it to them for $1 a month. They're living with their parents and they're totally fine with that. Everyone's going to have a different situation or a different need, and so the key is just to plug that information into our system and allow them to figure out kind of what to do or how they should go about doing it. So at this point, we would then just send them this report. Our clients can go start shopping for homes. We update this report every time they look at a different home. We find the tax information, we get HOA information, we get updated interest rates. And keep in mind, this is all with 3.25% interest rates. There's situations right now where our clients are writing offers and they're asking for seller concessions, where we can use that to buy out the mortgage insurance and buy down the interest rate. So in a situation like that, this can go away if you structure the offer correctly. And this goes down to 2.875. And this is happening right now, right? So this same client now has a payment of $37.90, right? Because they used seller proceeds to improve their financial situation. Now look at it, right? Now it's $94 difference. And over that time, they now have $60,000 more than they would have otherwise. And that's just by simply asking for like a 2 to 3% seller concession, which is available right now, but probably won't be available 6 to 12 months from now. So I know the entire title of this thing was find out if now is the right time to buy a home and why. I
love the seller concession. So just to give you guys an idea, so sometimes a buyer will say to us like, hey, we don't want to offer $650, we want to offer $640, right? Because that $10,000 savings might save you $5 a month on your mortgage payment.
Yeah, right.
But there's another strategy where us, Lenore and I know how to do this, where we present the offer like, okay, fine, we'll give you the full $650, but we also want you to help us with our mortgage rate. And it's something that Lenore and I work out on the offer, but it's such a smart way to go to kind of lock in that lower monthly mortgage payment for, like you said, it's a 30-year fixed payment. So you're locking yourself in for the really good opportunity. So talk to us about that if you guys have questions, because it's a really good opportunity.
Yeah, I mean, using that same $10,000 to buy down your rate or remove your mortgage insurance is equivalent to almost a $50,000 price reduction, right? So like most people think, well, I'm going to save 10 grand on the price of the home. It's like, well, you could have saved what was equivalent of $50,000 on that house if you would have used it appropriately. And that's just a product of working with a real estate professional and a mortgage professional that really have a good understanding of how to use leverage and how to use concessions to help with those things. So again, please don't try and do this on your own. It's not something that people have a high level of education in. It's not something that people understand at a high level. And even a lot of mortgage professionals don't understand this. A lot of real estate professionals don't understand these types of things. So I would urge you to do your due diligence when you're trying to get that information from people. And obviously we're here to help in any way we can. So that was, I think, the last thing I had. Was there any questions I can answer for you guys that would be helpful? If you guys have any questions or need anything, obviously here's my information. This is our website. You can, if you want to sign up for the Art of Homeownership, we essentially give you 6 really unique services, whether you own a home or whether you don't. It doesn't cost you anything. You don't have to pay for anything. We're not selling you anything. We just believe that there's a difference between owning a home and being a really successful homeowner, and Art of Homeownership members have the ability to do that at no cost. It's our commitment to our clients. Or you can email us here or call us, and then obviously, Danae would share her information in the post, and she has the ability to help in all the same ways which we do as well.
Yeah, awesome. Thank you so much for joining us today, Ryan. One other just quick thing I would mention is just that if you guys don't have the 5% down, there's some creative ways to get it. One, I think people don't necessarily realize is you can borrow the money from family. It's actually not borrowing it. It's a gift fund, right? So you can ask your parents to help support you. It's a great way to get into home ownership. The other thing is if you are currently renting, perhaps you let's say move inland to Orange as opposed to Corona Del Mar, just do it for 1 or 2 years just so you can save a little bit more each month and get into home ownership. Because I've seen it time and time again where, people get into the home ownership, they start with something maybe a little bit smaller than they wanted. But then 4 or 5 years later, the 2-bedroom, 2-bath condo turns into the 3-bed, 2-bath townhouse. And then that townhouse turns into the big house with a pool in the backyard. So you got to just get in the game. If you get in the game, it should be really good for you. But just know, like Ryan said, we will never push anybody to do something outside their comfort zones. We just want to support you. You'll hear me often say, I don't care if you buy, or because if you just tell your cousin, like, hey, Danae's a great realtor, that's all we want, so we're here to help you guys with genuine advice. And I only team up with people who feel the exact same way. That's why Ryan is invited anytime to be a part of this. And Lenore is a good one, like Ryan and I too. So anything you want to add, Lenore, before everyone jumps?
We do have one question in the chat for you, Ryan, and the participants asking that I was told that loans greater than $765,000 are not currently available. Could you speak to that, please?
Yeah, it's just another good example of misinformation and information that's floating out there that's not real. There's some truth to it. So anything above $765,600 or $765,600 is considered a jumbo mortgage, right? But jumbo loans are still available. They're harder to come by. They're more difficult to qualify for than they used to be. They require more reserves. The number of lenders offering them have diminished quite a bit. So it's a lot of the big FDIC banks, the B of A's, the Wells, the Chases, they're still offering them, but they're a bit more of a challenge than they used to be. The independent mortgage banks or mortgage brokers, we still have resources or access to them, but it's the reason why it's a challenge is because Fannie Mae or Freddie Mac loans, which is that 765 or below, there's insurance, right? Those government entities insure those loans against default. When you get over that, there's no insurance, so it's more of a risk for the lender. So they still do exist. They're just more challenging to come by. There are ways in which we help people avoid that by doing first and second loans. So for example, you can buy a $1.4 million house and you can put as little as 10% down. You can get a conforming first loan and then a second loan to go behind it at really good interest rates because the prime rate is so low. And there's a way to still qualify easier with less requirements, less reserves. So there's still a lot of creativity that exists in the marketplace today. And the faster we get through this and the faster that COVID goes away and we start seeing more liquidity and stability in the markets, we'll see all that stuff come back. But that's why it's really important to, I would almost say, don't believe anything you read right now, because it's so difficult to get really good information. That's why I say work with someone you trust. Go online, look at their reviews, look at their track record, see their performance, and get a good feel for who you're working with, and then get that information specific to you, not just a headline.
Well, Ryan, isn't it common too that in general, the biggest loans that we would typically see, pre-COVID and everything, is right around $1 million. So you can still do those loans easily. It's just the 765 is kind of the magic number as far as getting a conforming loan. Anything under 765, you just got to look at their personal scenario to make it happen. But those jumbo loans do still exist.
Yeah, they definitely exist. And again, it's all a product of how well qualified are you, right? I mean, how much reserves do you have after closing? What is your debt to income ratio? It's challenging for self-employed people right now because you have to really show that you're still making good income currently, not just that you did in 2019. And again, these things will change, but it's all going to be a product. I mean, once forbearances stop or become less of a thing, lenders will feel a lot more comfortable in opening back up their lending standard. Because right now, Danae, if you were the lender and you were about to fund a $800,000 loan for me, and you knew that I might not pay you for 6 to 12 months, you might not be so eager to give me my loan, right? So you might want to really make sure I'm going to pay you. So a lot of that's happening right now. It's a product of the time, but we think when this thing blows over, which we, knock on wood, hope it will, we expect to see normalization in the credit markets again.
Okay, so another thing, Ryan, is that with the $765,600 loan limit, that means you could purchase up to $800,000 even with an FHA loan. Is that correct? And FHA loans are 3.5% down. Is that the lowest amount we can see for a purchase up to $800,000?
Yeah, so I mean, technically, $800,000 would require $35,000 down to get to that 765 number. So it'd be a little bit more than 3.5%, but it'd be close to that, right? So I think 790, do the quick math on it, times 0.965. Yeah, 792-ish. I mean, it's very close, right? So FHA is still allowed there. You can do as little as 3.5% down. FHA is going to be more for credit challenged buyers, people that have, credit scores that are sub 700. That's really the only reason you would do an FHA loan if you have 700 credit scores or above, because FHA is going to be a little more expensive, right? They're going to have higher mortgage insurance. They're going to have a mortgage insurance premium. But for some people, it's a good product if there's credit challenges. You kind of think about it, Danae, to your point earlier about buying a home versus the home, right? Like the key is just that we have a train. The real estate market's like a train that's picking up speed, and it's like if you can get on, then you can just move up the cars on the train, right? You can start to move up and up and up. But if it keeps going faster and faster and you never get on, you'll never get to the front, right? Like you're always going to be chasing the train. And the real estate market right now is even historically is just like that, right? So the key is get on the train, regardless of what your concerns or fears may be, as long as it makes sense for you, right? And that's the key is don't let anybody sell your house or try and get you pre-approved if it's not the right time.
Sure.
And make sure you're working with somebody you trust to give you the advice on if it's the right time for you.
Yeah, that's a great point. And one more question about the FHA loan. Is it true that the FHA loan debt to income ratios are more forgiving than on a conventional type loan?
In a pre-COVID world, yes. In a post-COVID world, not so much. A lot of lenders have really, those loans probably were the hardest hit in terms of, they used to be able to go down to 500 credit scores. Now they're up into the 600s, mid 600s. Some people are even going higher. They used to be able to have credit score or debt ratios that would get up into the high 50s. Now those are down into the low 50s, high 40s. But it was all a knee jerk to what happened, because the last thing you want to do is lend money to somebody who may have challenges paying it back. I mean, you just don't even want to put someone in that situation, even if they wanted to be it, because sometimes you have to protect people from themselves. So we think that'll loosen up as well, but and every lender is going to be different on how they handle their guidelines. So some may be more liberal than others, some may be more conservative than others. It's just a product of what their position is on it.
Okay, great, thanks.
Yeah.
Well, you know what else too, Ryan? Recently you helped one of my clients that we determined it actually was not the right time to buy, namely because of some debt that she had to pay off. But what's cool is you guys help her plan, right? So if you don't buy right now, then we help you with a plan on when is a good time to buy and how are we going to get there. And I believe you even got her hooked up with a credit company that was going to help her look at some different scenarios there too. So
yeah, that's the whole crux of it, right? Is it, if I go talk to the average renter on the street or in their house, maybe not on the street, and I say, are you going to be buying a house? Almost all the time you're going to hear, maybe at some point. And that's a real problem, right? Because that person should either say, yes, I'm confidently going to be buying a house and I'm doing that now, or no, I'm not buying a house, but I have a plan and a strategy in place to buy one, 2, 3, or 4, or 5 years from now. And I'm working with a team that's helping me accomplish that. If you don't have one of those two answers, you're really short selling yourself. Like everyone deserves to have a plan, right? The lack of a plan is just someone being lazy or afraid. And you don't need to be either of those things, because we do all the work for you, and there's nothing to be afraid of, because you're either going to learn that you're going to get to buy a house, or you're going to learn about the best strategy and timeline to be able to confidently do that. So I just don't understand why people allow themselves to not know. Well, I do, because most people don't know that mortgage companies do what we do, or realtors do what you do. They just think when I decide to buy or sell or finance a home, then I'll call somebody. But again, we don't teach real estate. We don't teach finance. So it's no wonder that people aren't making good decisions or searching that information out themselves. So if you're watching this, please don't be in the middle. Like, confidently know you are, or confidently know you're not, with a plan and a strategy and a timeline.
Yeah, it's so good.
Any other questions I can answer for you, or anybody else have anything in the chat?
I'm looking at Facebook. It looks like we're good on this end. Anything on your end, Lenore?
Nope, chat's clear now. You answered all those questions. Thank you.
Well, reach
Yeah.
out to us if you guys have any questions. We work as a team, so pick your favorite, whether it's me, Ryan, or Lenore. We're all here to support you. And this is recorded, so I will post this on YouTube as well. So if you have any friends you want to share it with, please feel free to share the link. And we hope you guys have an awesome Thursday coming into the weekend soon. And thanks for hanging out with us. See you guys.
Thanks,
Oh,
everyone.
wait, one more chat. Hang on. Oh, it was a thank you. All right, everybody.
You're welcome.
Okay.
Bye.